Joining our closing bell exchange to talk about the market action today, Larry Glazer from Mayflower Advisors. Gordon Charlop from Rosenblatt Securities is here at Post 9, and Holly Liss from BTIG joins us. Holly, were you encouraged by what you heard from Chairman Powell, as the market seems to be?
I wasn't sure. I was encouraged, but stocks are clearly doing better than the fixed income markets are. We're seeing new highs, longest expansion, whereas if you look at interest rates, the long end of the curve is not moving all that much. If you look at the 10-year rate, for example, since the start of 2017, we've had the narrowest trading range since 2005. I think it's about 112 basis points. So the long end of the market is not that much of an impact from what Chairman Powell said this morning and what some of the other Fed governors and the bank presidents have been saying. And I think that's because you've got a lot of demand for our interest rates, especially from overseas markets, from insurance companies, mortgage servicers. There's still a lot of demand for our products relative to, say, the shorter end or some of the other countries.
So, Holly, that would suggest that there's a steady demand out there, but also perhaps that the Federal Reserve is on a relatively predictable path that the markets are comfortable with. Otherwise, you might perhaps see more volatility. Is that what you're suggesting?
Mike, I have to agree entirely with that. And I think you're seeing that complacency, especially at the long end. The one thing that I think could really do something here is the more that you get these Fed members saying that there's flattening of the yield curve may not be as much a signal as it has been in the past. It may not be signaling a recession in the next 12 to 18 months, something like that. I think the more that they say that makes the markets a little bit more concerned and also are going to force that issue and flatten the curve. They tend to like looking at the 3-month 10-year, which just hit its lowest level, I believe, since 2007. It went down to 72 basis points. So you're now, granted it's not a lot, but you're above 10% odds of seeing a recession in the next 18 months. So I think the market could push that further, especially you see another rate hike in September. And here's an interesting note. The 10-year yield has traversed the 234 level every year since 2008. So far, this is the first year that we haven't, but we do still have 4 months left to go. So if you get the rate hike of 25 basis points, if you see that 10-year go back to 234 and we're not seeing inflation, so that could be when you see the curve very close to inversion, if not already in negative territory.
Gordon, the market started higher, stocks that is, and they appeared to get a jolt from Chair Powell's speech all the way up to record highs.
You know, there's two sides to it. I mean, first off, the interest rate story is very important, but it's also the dollar. And with President Trump whispering in the Fed chairman's ear to not be too much of a cowboy out there, I think that the investors feel that there's been a nice balance struck between the two. Currently on the floor, I think people are feeling as the American consumer goes, so goes the market. And we've seen, notwithstanding today where they've backed in a little bit, but good strength in the retail sector. That tells you that the American people are going to their pockets, getting out there spending. And that's been the key that has probably been missing when you go back to why the market's been languishing at certain points.
Larry, where does it take you as an investor in terms of trying to figure out, because one of the big questions obviously has been just where are we in this cycle? Will the Fed hasten the end? Can they kind of give it new life? And we have this stock market that has made, you know, a fairly impressive steady return to the old highs, but it's not exactly with a lot of force behind it, a lot of enthusiasm, a lot of energy. So where does that take you?
That's right. Look, there's no question that a dovish and more gradual rhetoric coming out of the Fed is just what the doctor ordered on a Friday in the summer. But recognize here, what the Fed is really saying to us is, don't worry, enjoy the last few weeks of summer if you have them. This is the home stretch. Come the fall, if we're worried about valuation, which the Fed seems to be concerned about, if we're going to have a more dovish posture, maybe the leadership of the market is really due to change come September, a more seasonally volatile period of time, regardless of what's going on. Look, the Fed is only one piece of the equation for the markets coming into the fall. You have midterm elections, a major, major issue, and of course the overhang of trade policy. But from the Fed's perspective, this is going to move us into that knee-jerk reaction that you mentioned, into other leadership areas of the market. So you see emerging markets hurt by higher rates, but also by the dollar. Maybe they do a little bit better. They're certainly doing that today. You see gold left in the dust. Everybody hates it. Don't go near it. Getting a little bit of a bid here. So this is where you get some excitement coming into the fall because you can see that change in leadership. So investors going into that, they don't want to be, it's a fine line between confidence and complacency. And that's exactly where we are right now. There's a lot of confidence and complacency. The trade gets resolved. it's like a no-brainer. Everyone thinks trade gets resolved. It's not necessarily how these things will play out in the fall. So changing leadership around the Fed's concern about valuation is a great strategy for investors if they're going to connect the dots.